Corporate Finance Presentation, Cost of Preferred Stock. Get ready, it's time to take your chance with Corporate Finance. Here we are in our weighted average cost of capital, the WACC or WACC formula we looked at in a prior presentation, as well as a table down below that gives us a conceptual idea of what is going on with it and an example at calculation of it. As we do these problems going forward, you want to keep in mind the general idea of this concept, that being that we're looking at financing options that basically have two buckets within them, one being debt financing, one being then the equity financing. Then we can focus in on the specific components or the costs of debt financing and equity financing. We're now focusing in on the equity financing, and when you think about equity financing, you're usually thinking about the common stock, the issuance of the common stock. When you issue the common stock, you're giving basically value in the company or ownership in the company, claims to basically the retained earnings within the company. That can be a little bit more complex than, say, the preferred stock. So the preferred stock is a nice intro into basically the common stock. The preferred stock will differ from the debt financing because the debt financing, as we talked about in prior presentations, has a tax component to it. We pay the debt financing off with interest, typically the rent on the money, because that's an income statement amount. We're talking about an income tax. There's a tax component. So this calculation here is going to be calculated after taxes so that we could compare it to something like the equity financing. And then before we get into the equity financing of the common stock, which is a little bit more complex to estimate, it's useful to take the next step to go to preferred stock. And maybe all companies may not have the preferred stock financing option. It might not be the first thing that comes to mind when you're thinking equity financing, but if it's there, it's going to be a more simplified kind of way to think about due to the fact that the preferred stock doesn't have that same kind of voting rights and therefore the same kind of claim to the retained earnings. And what we could value with it will then be the dividends. We can basically look at the dividends that will be paid in a similar fashion to the debt that would have interest paid to it and do a similar type of calculation. And it's even easier to some degree due to the fact that we don't have that tax impact with the equity financing because there's no impact on the income statement when we pay out the dividends on the preferred stock. Note that if you're looking at the preferred stock, we could add a component to the formula up here for the preferred stock and look at it in a formula basis, but I'm not going to do that here because I want to look at it as an intro into the common stock and think about the idea of having two major buckets when you're thinking about the financing, the debt financing, and then the equity financing. So the calculation for preferred stock will be similar to the debt financing here, but just note there's another difference in it, and that is that there's the maturity date for the debt financing. Even if you have a long-term bonds, like 30-year bonds, there is a maturity date. When you're talking about the preferred stock here on the equity financing, there's no real end date. You're paying dividends basically infinitely kind of into the future. So you have that difference that's going to be involved. So when we do these calculations to try to compare the same thing to the same thing, taking the after-tax impact here, this kind of annual basis tax on average, you can think, for the debt financing, and this is kind of the average annual for the preferred stock. So you can kind of compare those out, but we're doing the best we can to be able to compare them, noting that we still have to take some changes and differences in consideration. Once we have those, then we can apply the weights for our capital structure, as we saw in prior presentations, to get to the weighted average cost of capital. And that can help us with our financing, basically, decisions here. So the cost of preferred stock. The preferred stock has a constant dividend payment with no end or maturity date. So note, we're looking dividends, and we're thinking about valuing it then. If we're thinking about the value of it or the cost, we think of our same concept of looking at those dividends out into basically infinity and then trying to present value what that would be. So then we will divide dividend payments by net price received, price less any flotation costs being the one-time cost of the issuance. So we have this added kind of thing we want to take into consideration. It could be a little costly for the issuance of the stock, so we have to basically pay for the issuance of the stock, whatever kind of admin costs would be there. That cost is different than the dividend cost to us because it's a one-time cost, as opposed to the dividends, which are something we pay annually. We're going to assume it on an annual basis, basically in forever, in theory. So this gives the rate of return to preferred stockholders and annual cost to the corporation. Because preferred stock is paid from equity, there is no tax impact or tax adjustment. And this is, of course, one of the major differences with the debt financing, which is why we need to make that tax adjustment so we can compare this to the debt financing and try to look at similar types of things and then use that information possibly in order to do the weighting. So that we have the cost of preferred stock formula here. Cost of preferred stock will equal the annual dividends, the dividends that we're going to pay. So we're imagining we issue the preferred stock in order to get financing, in order to get money, and then we're going to pay an annual dividend divided by the price of the preferred stock minus the flotation. The price of the preferred stock, obviously what we got, that's what we got, minus the flotation cost. So this is what it's going to cost us, the annual dividends per year, basically on an annual basis, minus the price of preferred stock, that's what we got, minus the flotation costs, because that's the one-time cost that we had to give in order to issue the stock. So it would look something like this. We have the annual dividend per share in a table type of format would be 8. So we're assuming we pay $8 per share for the dividends. And then I would call it the net sales price down here, right? This is our net sales price, which is basically the sales price of the stock. We're assuming 130. That's how much we sold it on the market for. We will sell these on the market. So, of course, it will depend on what people are willing to pay for the preferred stock so that we set the price as high as we can in order to sell it on the market for that 130. And then we're estimating the flotation costs at $2. So it costs us $2 to issue the stock. That $2 is different than the dividend up top, because the dividend is going to be an annual type of payment. We're assuming it starts basically at the end of the year after the issuance. Whereas the $2 down here is the one-time payment. So if we were to sell it for $130, we got to pay the $2 per share, here up front. So that means we're really only getting $128 after the cost of the issuance. Then we can compare the $8 that we're going to pay on an annual basis to what we got, which isn't $130, even though we sold them for $130, but the $128 after the one-time issuance costs, and that'll give us the cost of preferred stock at the 6.25. So now that 6.25, we can compare to other type of financing options. Now, if I want to compare it to debt financing options, then I got to make sure when I look at the debt side that I take into consideration the tax impact, because there's a tax impact on the debt side. There's not a tax impact here because this is coming out of the dividends. That's still not perfect, because we still kind of have this situation where, you kind of have an equity type of interest versus the debt interest. You have a difference there, and we have a difference in basically our capital structure. So we might have, you put this into our weighted average cost of capital type of calculation, and the dividends up top, once again, will in theory be paid forever, right? This is going to be paid forever versus the debt, which even if you're talking about long-term debt, 30 years, then the dividends have some type of maturity date. So nothing's like a perfect comparison. They're different things, but we want to make them as much as possible to be on a comparable basis so that we can make the best decision we can based on the best information we could put together.